This task force, the profit equation, the mission, how a corporate tax holiday will ultimately affect investors. Our task force members today is Tom Lee. He's the chief U.S. equity strategist at JPMorgan Chase. He has written extensively on this issue. Also with us, Vassili Serebriakov. He's currency strategist at Wells Fargo. He is one of the most accurate predictions of emerging market currencies, and that makes him a Bloomberg best. Gentlemen, welcome to the task force. So, Tom, let's kick it off with you. Repatriation, is it a good or bad idea?
Repatriation is a great idea. You know, I think the current tax code doesn't favor companies bringing money back into the United States. So, you know, providing a tax holiday is a fair window, and companies can bring the cash back in and really do a lot of things with the cash. Invest, hire, buy back. I mean, there's a lot of constructive things that can be done. Even
though they showed last time that there wasn't a lot of hiring, that yes, they used it to increase dividends, do a lot of stock buybacks, you still think it's a good thing?
Well, you know, it really depends on how you're measuring the productive use. When a company's paying a dividend, it is generating investment income for the recipient. Mm-hmm. You know, the majority of stock is held by individuals, so this really generates W-2 income. And
there's a wealth effect off of it.
There's certainly a wealth effect. In fact, and if companies buy back stock, that lowers risk premium. And again, there's the wealth effect created from actually rising stock prices.
Vasili, what's your take? Good or bad idea?
I think if the U.S. economy remains weak, it's better than nothing. It's better than not having repatriation.
That doesn't sound like a ringing endorsement.
It's still, I think the point remains to be seen how much stimulus it actually provides for the economy and exactly how the money is going to be used. But I think as long as it supports the financial markets, and if we go back to, for example, the Fed's QE2, that was one of the main ideas, is to support financial markets. Even if those companies pay dividends, it's positive for U.S. stocks and probably positive for the financial markets overall.
I mentioned to Tom that we've been here before, and that's kind of item number 2 on the agenda. There was a temporary corporate tax holiday back in 2004. You had $362 billion coming back to the U.S., according to the IRS. But the study that I referenced, Tom, a study from the National Bureau of Economic Research showed roughly 92 cents of every repatriated dollar went to stock buybacks and shareholder dividends. So, Vasili, let me ask you, though, do you think it will be different this time around? Everybody talks about a new normal. Would it be different when we talk about repatriation?
Well, what will perhaps be different is the amounts might be actually larger, because I think by the estimates, the amount of cash being held overseas is larger than last time. Of course, the talk is to attach some strings to the, to bringing money back, and perhaps, force or incite companies to invest that money instead of paying it out as dividends. Of course, then you have the opposite effect of discouraging some of those flows back.
Right.
So I think it's too early to say whether it's going to be different. But again, I think it's more positive than not doing anything.
I mean, even if it's not different, Tom, this time around, you think it's still worth it?
Yes, and one, it's very hard to create an audit trail, for a dollar coming back and how it's spent.
So you question the research then?
Well, I think it's going to be hard to impose requirements on companies on how the money's spent, because money's essentially fungible. Mm-hmm. But again, if it's a dividend, it is wage income. It actually adds to GDP that way. In the same way that if they were to invest in an infrastructure.
So still a good thing.
It's still a good thing. I think it carries bigger punch than QE.
Let's get to item number 3 on the agenda, and this is the market effect. Tom, you actually wrote in a note a few weeks ago that healthcare and technology are 2 sectors that have a lot of cash overseas. So significant than the impact it would have on the market, in your view? Potentially.
Yes. In fact, it's a really big deal for companies that have overseas operations where their development costs occur in the U.S., because then they're generating huge, disproportionate margins overseas. And the ability for them to bring this back and redeploy it and then reinvest it for R&D is a big deal. If they keep it overseas, they can't really use it because all their R&D facilities are in the U.S. Yeah.
Vasili, what about a currency impact here?
Well, I think from what we saw last time with HIA1, the currency impact has been positive. Of course, it's hard to differentiate, currency impact of this particular measure from other things. Back in 2005, of course, the Federal Reserve was raising rates very actively, so some of the support may have come from interest rates, but I think it's generally perceived that those flows, those repatriation flows, especially as the funds were being converted from foreign currencies, that helped the dollar.
And Tom, I want to talk about your kind of prescription for investors as a result of this. You mentioned earlier that a corporate tax holiday would pack an even bigger punch than QE2.
Yes.
How come?
Well, it's QE was an indirect transmission mechanism, meaning it was really trying to force investors into the risk curve to buy equities. And I think when we look back, earnings during this period rose 16%. So about 7% could be attributed to lower risk premia, which you could say is the QE2 effect.
Right.
This repatriation could be $750 billion directly invested in the stock market. So instead of $800 billion buying treasuries, this is $800 billion going right into stocks. I think it would have a huge effect on risk premia, which currently is at 4.83%. I mean, it's almost a 50-year high, and 2.5 is normal. That's almost 3 turns in PE right now.
It's a big difference there.
Yeah.
Hey, and you've actually listed 12 stocks that could benefit. Talk to us a little bit about the areas and so on.
Yeah, what we looked at, and this is some of the data that Dane Motter, our accounting analyst, put together, was looking at companies that had a large percentage of their market cap in undistributed foreign earnings. It was very concentrated at the industry level in cyclicals like auto parts, healthcare, biotech, and so this listed 12 names, which I'm not sure if it's up on the screen, are companies that have very large market cap, percentage of market cap in undistributed earnings, but also actually are rated overweight by our analysts and have material stock price upside.
Right, and a lot of them are well-known names.
Correct. They're branded, high-quality businesses. Exactly.
And Vassili, let me ask you, because you think the economy will have more to gain from a corporate tax holiday if the economy is stronger. So you kind of have criteria with that.
I think in terms of its impact on the economy and the financial markets, I think it will make a difference of where the economy stands right now. First of all, in terms of there's been a lot of talk about the fact that the companies have a lot of cash, but perhaps there isn't enough demand to encourage investment into sort of productive use. If the economy is stronger, perhaps there's a greater drive to invest that money in research and development, employment, and so on. And I think a second point is, as far as the dollar is concerned, it will probably help the dollar, as we already mentioned, but the effect will probably be short-lived unless, again, we see a stronger economic recovery and at some point a different Fed policy.
Vassili brings up a good point, Tom. I mean, do you think it'll pack more punch if the economy is stronger in terms of the repatriation? Does it matter in your thinking?
I mean, I think the repatriation could help the economy, so I think it would make it stronger,
So it doesn't have to be a strong economy for it to have more effect, in your view?
That's right. And, in some ways, businesses, especially CFOs, always are a lot more confident when their liquidity is stronger. So I think you're going to much more likely see companies loosen their purse strings on capital spending if they've got excess liquidity anyways.
Vassili, I say 15 seconds for you just to respond to what Tom said.
Well, I think a stronger economy would make sure that the effect is medium term rather than short term.
All right, we're going to leave it there. Tom Lee, Vassili Serebriakov, thank you so much. Appreciate it.
Thanks.
All right,